Financial accounting. We have covered chapter 1, chapter 2. In chapter 1, we have covered about different types of organization, the difference between management and financial accounting. Who are the users of financial statements? What is the purpose of financial accounting? In chapter 2, we have discussed accounting is done by accounting standards and how many bodies are involved in setting of accounting standards. So let's start the main accounting from today onward. The main accounting for how to record transactions. How to record transactions. This how we record transaction? We record something as a debit and something as a credit. We adding as a debit of say 10,000. There should be something as a credit of that. That should be white transactions. Mean they do of the right. The same amount is what comment is that it will make debit. We are going one of 8,000 and debit component of 2,000. Credit will be one component will be so it will 10,000 and 10,000 is one. So that so this is what this is some there are five heads. Five heads. Asset. Changes. Liabilities. Income. And you. It's also certain expenses of that nature. Asset expenses are liabilities, income, and equity. These values are having credit. So nature of asset and expenses is debit, while nature of liabilities in and equity is then as the leasing when increasing expenses are increasing debit. Cash is asset. Here is what motor vehicle or vehicles are assets. Cash is what will credit. We have small vehicles, motor vehicle is going credit. Expenses. We need to pay rent. Rent is easy to debit. We need to pay electricity bill, expense with debit. Because they are having arbitrary nature, asset and expenses, and when they are increasing, we will debit them, and when they are decreasing, we will credit them. Liabilities, income, equity, they are having credit nature. So their increase, we will credit. According to nature. If nature is debit, increase will be debited, decrease will be credited. If nature is credit, then increase will be debit and their decrease will be liabilities increase will be credit because they are having credit nature. And their decrease will be against assets. Increase, yeah, increase will be against nature mean increase in cash we so we that balance is can be of 5,000 is so we will debit cash on 5,000. So credit account balance that is same with 5. If cash is in, we will record it as debit. Yes, I saw debit. If cash going out from business, cash going out, whether we should debit cash or credit cash. Credit. It has the currency if cash we will deposit our credit and other account balance sheet debit. We have purchased goods for cash. Rupees 8,000. We have not on the credit side. We will record cash with 8,000. So the balance will be on the balance purchase. These two we need to remember for accounting process. As expense is of data nature, so there is be data and the decrease will be liabilities income equity is having credit nature. Decrease will be credit decrease will be against the nature mean. If cash is coming in, we will debit the cash and the other account head will be credited. If cash is going out, we will credit cash and other account head will be debit. Is that fine? Let's record the accounting entries for this. Part A. We need to record accounting entry only. Owner puts $10,000 into a separate bank account for the business. Owner invested 10,000 into the business. For the business, cash is coming in or going out. In that, if owner put 10,000 into the business, for the business, cash is coming in or going out. Going out. Business paying the cash or receiving cash. Business receiving cash. Business receiving cash. So cash is coming in. Cash is coming in. Cash is asset. is increasing. This means we need to debit what? On debit side, we need to record what? Cash, how much?
Cash,
10,000.
10,000.
And on the credit side, we will record the other account head. What is other account head here? That will be called capital with the same amount. Can you understand this entry?
While capital.
The owner investment into the business is called capital, or it will be called equity. Equity or capital. Part B. Mean B transactions. We need to record this. The business buy a shop for 2,000. Business bought a shop for 2,000. What is a shop? Asset. Asset. So what we will record? Business buy for 2,000. Cash coming in or going out?
Going out.
Going out. So what we will do? We will credit the cash with how much? 2,000. And we will debit what? Shop asset as 2,000. Shop asset with 2,000. Is that fine? C entry. The business buys good for resale for 1,000. Business have bought goods mean purchased goods. Business have purchased goods for 10,000. Cash coming in or going out?
Going out.
Going out. So we will what?
Credit.
Credit the cash with 1,000. And what could be the debit side? The other account balance mean we are purchasing the good. And if we are purchasing the goods, we will use the word purchase. If we selling the goods, we will use the word sale. If we are purchasing furniture, building, we will use the word furniture, building rather than purchases. Purchases word will be used instead of goods, inventory. Is that fine? D. The business buy more goods for resale on credit 2,000. Now business is buying goods on credit. On credit means business will pay in future. Business is not paying cash here. On credit means business is not paying cash here. Business will pay in future. This means they have bought goods. So purchases will be debit. What will be debit? Purchases. With how much? 2,000. And they are not paying cash. From whom they are buying the goods? Supplier. So supplier is called payable.
Yeah.
So we will credit supplier or payable with the same amount to 2,000 mean we will pay this in future. There is no cash involved because we are buying on credit, on loan basis. We will pay in future. So purchases will be debit, but the credit we will record supplier will be called payable. This is our liability. Liability increasing. Its nature is credit, so we are crediting it. E. The business buy a car for 3,000. Cash. So cash coming in, going out. Cash coming in or going out?
Cash going out.
Going out. So we will credit cash. How much? 3,000. And we have bought not goods, we have bought car. So we will debit car with 3,000. Can you understand this concept? F. The business sells half of the goods for 2,400. Cash. cash coming in, going out,
Cash.
coming in. So we will debit cash
Cash.
with how much?
Uh,
2400. And we have a sell. So we will credit what? Sale
cash.
2400. Is that fine? G. The business sells the remainder of the goods for 2800 on credit. Now we have sold the goods on credit, mean we haven't received the cash. So what we will do? We will record credit sale as we recorded here. But on debit side, not the cash. On debit side, we will record customer.
Customer.
And the credit customer will be called receivable
Receive.
with 2800. Or instead of receivable, you can record debtor to whom we need to receive money in future. Or you can say we need to record customer name. So if we sold goods on cash, the entry is cash debit sales credit. If we are selling goods on credit, the entry will be receivable debit and sale credit. Mean the customer to whom we are selling on credit will be called receivable. And receivable will be our asset. We will record as asset. H. The business pays 600 of the amount owing on account. To whom we owe? To supplier payable from whom we bought goods on credit. So we are paying 600 to the payable, means supplier. Cash coming in or going out?
Cash. Cash. Going out.
Going out. So we will credit what? Cash. How much? 600. To whom we are paying? We are paying to payable, means supplier. So payable with the 600 will be debit. Payable of supplier from whom we bought goods on credit before. Now we are paying to them. If we are paying, cash will be credit. To whom? Supplier.
Supply.
Payables. The business pays electricity of 200.
Cash going out.
Cash going out. So we will credit what? Cash. How much? 200. What will be the debit? Electricity expense. Electricity expense with 200 amount. Electricity expense. Debit, cash, credit. Next J. The business receives half of the amount owing to it on account. We receive half of the amount from whom? To whom we sold the goods on credit. Where we sold the goods on credit? Here. How much goods we sold? 2800. So we are receiving half amount from receivable. Mean 1400 is coming in. So cash coming in. What we will do? We will debit the cash with 1400 and credit what? Receivable with 1400. Is that fine? This is relating to that entry, credit sale. Because we made sale on credit 2800. So now we are receiving 1400 as we have a paid here to payable 600. Next. The owner takes 1200 from the business. The owner took 1200 cash from the business. Cash going out or coming in?
Going out.
Going out. So we will credit
Credit. Cash.
cash. How much? 1200. The amount withdrawn by the owner from the business will be called drawing. What will it will be called? Drawings. Drawing, debit, cash, credit. The amount owner invest into the business is capital or equity. The amount owner withdraw from the business will be called drawing. Is it fine?
Yes.
So we have learned how to record accounting entries. How to record accounting entries by keeping this concept in mind. If cash coming in, we will debit it, the other account balance will be credited. If cash going out, we will credit it and the other account balance will be on debit side. And the asset and expenses are having debit nature. So their increase will be according to nature mean debit. And their decrease will be against their nature mean credit. Liabilities, income, equity is having credit nature. So their increase will be according to their nature mean credit. And their decrease will be against their nature mean debit. And we have learned how to record accounting entries. Is that fine? Now we are moving towards some different concept. Now leave the accounting entries. Just focus on this part A. What is part A? The owner puts 10,000 into a separate bank account for the business. What could be the accounting entry? Cash, debit, capital, credit. What business on from this transaction? So business on what? Cash of 10,000. What business of? The owner money we owe to the owner. He can withdraw from the business anytime. So what business of? Business of capital of 10,000. And this on and off should always be equal. What business on according to this transaction? Cash 10,000. What business of? Capital 10,000. Now moving towards next transaction. The business buy a shop for 2,000. From where? From this cash. This means what business on? Cash, not 10,000. 10,000 minus 2,000. Business on cash of 8,000. And business on a shop of 2,000. Altogether 10,000. What business of? The similar capital of 10,000 and on and off are equal. In every transaction, the on and business of should remain equal. Now, see. The business buy goods for resale in cash for 1,000. Business buy goods for 1,000. From where? From cash. How much cash business is having? 8,000.
8,000.
Now business will on what? Cash of 7,000.
Yes.
Shop of what amount?
1,000.
2,000. Now shop was for 2,000. And now business bought goods. Goods will be called inventory. For how much? 1,000. So what business on? 10,000. And what business of? Capital will remain same as 10,000. So on, off, equal. From here, we are moving towards transaction D. The business buy more goods for resale on credit for 2,000. Now business is not paying cash, but goods are coming of 2,000. So what business on? The same cash of 7,000. Shop of 2,000. Before these 2,000, there were 1,000 goods. Now the inventory will be
3,000.
Inventory will be 3,000. So what business on now? 12,000. So what business of now? Capital will be same 10,000 and remaining 2,000 that business bought on credit will be payables.
Payable.
How much? 2,000. So this will also become 12,000. If we bought goods on cash, we will deduct from cash. If on credit, there will be a liability. Liability means business of. To whom? Supplier. What's the name of supplier? We will call it payable. Is that fine? So we are having cash 7,000, shop of 2,000, and inventory of 3,000. How 3,000? 2,000 we bought before. 2,000 inventory we bought, now 1,000 inventory we bought here, and 2,000 we bought now. So 1,000 plus 2,000. Now moving towards E. The business buy a car for 3,000 cash. So car asset coming in, cash going out. How much cash business was having? 7,000. So now business will be having cash of how much? 7 minus 3, 4,000. What business on else? Shop of 2,000. Business of what? Inventory of 3,000 and a car of 3,000. What business on? The same 12,000. And what business of? The same capital of 10,000 and payable of 2,000. Altogether on off equal. The business sell half of the goods for 2,400 cash. How many goods business were having? 3,000. Out of this, half gone. And business receive cash, how much? 2,400. So cash will be now 4,000 plus 2,400, 6,400. Shop will remain same of 2,000. Car will remain same of 3,000, but inventory will be half. How much? 1,500, because half inventory we sold. Though we received cash 2,400, but inventory will be half. I mean, before it was 3,000, now the remaining inventory cost will remain 1,500. Now what business of? Capital and payable. So same capital with 10,000 and payable with 2,000. How much is this on? How much is this on? Can you calculate this? 0, 0, 6 plus 5, 1, and 7 plus 2, 9 plus 3, 12 plus 1, 13,100. 13,100? Enough? Or something different? We sold goods 2,400 cash. Is that 13,100? No, no, no. It's not 13,100. This is 0, 9, 12,900. While on the of the side, it's 12,000. What is the difference? 900. That 900 we will record here and we will call it a profit. That will be added to capital. Means this will become 10,900 plus 2,000 will become 12,900. How it is a profit? The inventory was 1,500 that we sold half. For how much? 2,400. So there is a difference between 2400 and 1500 of 9. We can perform check on profit. How? We sold the inventory, means sale was 2400. The cost of sale was 1500. Half of the inventory. The inventory total value was 3000. So we sold the half of this. Half mean 1500. So the selling value inventory cost that we have sold is of 1500. So 900 will be our profit.
Profit.
And this profit will be called gross profit. Sale less cost of sale. Sale less cost of sale. Cost of sale mean the inventory we sold, at what amount we bought that inventory. So this 900 is our profit. So that on and off should remain same. Okay. Now we are having cash 6400, shop of 2000, car of 3000, inventory of 1500. Capital including profit is 10,900 and payables of 2000. The business sells the remainder of the goods for 2800 on credit. Means the remaining goods of these 1500 we sold for 2800 on credit. Mean not received cash. This mean your cash will remain same 6400. Your shop will remain same 2000. Your car will remain same 3000. Your inventory will be, how much inventory will be?
I pay
0, because we sold.
already.
And we don't receive cash, we sell on credit. If we are selling on credit to home customer, we call it receivable.
Receivable.
We will record it as asset.
Receivable.
Receivable, how much? 2800. 2800. The inventory gone of 1500. And the asset up by 2800. So 2800 minus 1500. How much is the difference? 1300. What this 1300 will be? Profit, profit, profit. So what business on now? 008 plus 4, 2, 7 plus 3, 10, 12, 14,200. What business of? Capital
Joe.
of what? 10,000.
Talent.
Profit
Profit.
900 was before, now 1300. How much is that? 2200. And payables, how much was payable? 2000. Can you check if it is the same 14,200? 10 plus 2, 12 plus 2, 14,200. Tally both sides on and off. Is that fine? So now business is having cash of 6,400. Shop asset with 2000, car asset with 3000, inventory, nothing, gone, eliminate. Receivable of 2800, capital of 10,000, and profit through sale they have generated 2200, and payables 2000 that we need to pay. To the supplier. Okay. The business pays 600 of the amount owing. We pay The amount owing. Which amount owing? This 2000, from this 2000, we paid the 600. Cash going out. How much cash business was having? 6400.
65.
Now this will be reduced by 600. So cash will be 6400 minus 600. This will become how much? 5800. The shop will be remain same with 2000. Car will remain same 3000. What else we are having? Receivable of 2800 because inventory gone.
Receiving.
2800. What business on? 6, 6 to 8 plus 5, 13,600. What business of capital 1000, profit 2200? Capital 10,000, profit 2200, and payables was 2600 we have paid. So payable will be how much? 1400 instead of 2000 because 2000 was there. We have paid 600. So what business of is that equal to 13,600? Yes. Is that fine? Mean business capital is now 12,200. Instead of writing profit separate, we can say capital is now 12,200 and payables are 49. Okay. The business pay electricity of 200 from where?
From cash.
Cash. How much was the cash? 5,800. So now cash will be 5,800 minus 200 will become 5,600. And shop will remain the same with the 2000. Car will remain the same with the 3000. And receivable will remain the same 2,800. How much business on? 0, 0, 8, 6, 4, 6 to 8 plus 5, 13,400. How much business of the capital of 10,000, profit of 2,200, and payables of 1,400, and they will become 13,600. But we need to match with 13,400. So that expense business paid will reduce the profit. 200 we paid the expense. This will reduce our profit to 2,000. Instead of 2,200, it will become 2,000. Now the on and off will vary. Any income will be added to the profit, mean capital, and any expense will be deducted from the profit, mean capital. Now the capital will be 12,000. Either we can record profit separate or we can record into the capital. It will remain same. Is that fine? The business receive half of the amount owing to it on account. We receive half of the amount that we need to receive from whom? This is receivable.
Receivable.
So what coming into the business? Cash.
Cash.
So cash will be now 5,600 plus 1,400 will become 7,000. Shop will remain the same of 2,000. car will remain same of 3,000 and receivable will be now
we
half 1,400 because half we received, they will remain 13,400 same. Because 1,400 gone from here and added to there. And what business of will remain same? Capital of 12,000 and payables of 1,400. So they will be 13,400. Is that fine? Now cash 7,000, shop 2,000, car 3,000, receivable 1,400, capital 12,000 and payable 1,400. The owner takes 1,200 from the business. Cash going out. Cash going out. So cash was 7,000. Now 1,200 will be gone. So 7,000 minus 1,200. The remaining cash will be 5,800. Shop will be of 2,000. Car will be of 3,000. What else? Receivable will be of 1,400. So this will come 0, 0, 2, 6, 8 plus 4, 12,200. While our of is 13,400. How we can match this? See, capital
Joe
was how much? 12,000.
2,000.
We need to deduct from capital what drawings? How much? 1,200. Now capital will become how much? 10,800 and our payable will remain the same. How much? 1,400. So this will be tally now 12,200. Is that fine? What does mean by that business on? This mean by asset. What does mean by that business of? This will be called equity plus liability. Mean capital plus liability. Mean your asset should always be equal to equity plus liability. Mean your on should always be equal to offs. Can you understand this? What we have learned? How to record accounting transactions. Mean how to make debit credit entry. And we have learned how to equalize your debit mean on and your credit mean offs. In your asset should always be equal to offs, equity plus liability. Equity that we need to pay back to the owner and liabilities that we need to pay back to other parties. Okay, let's move forward. Now we're gonna see how the balance sheet means statement of financial position look like. We put a heading statement of financial position. And then we mention the year end as at 31st March 2009. Mean this is the year end of the company. Year end could be 31st December, could be 31st March, could be 30th June, could be 30th September. It's up to the company when they gonna close the financial year and prepare financial statements. So this company is preparing financial statements every year on 31st March. Statement of financial position include only asset, equity and liabilities. Income and expenses we record in profit and loss account. Assets, equity, liabilities we record in balance sheet means statement of financial position. How we record? First we record assets. And we have learned in previous lecture, there are two types of assets, non-current assets and current assets. Non-current assets mean the assets that provide us benefit in more than 12 months. And current assets, the asset that provide the benefit within 12 months. I mean, within 12 months, they will be finished. But non-current assets will continue for more years. What are the non-current assets? Land and building. Suppose these companies are having this much land and building. Plant and equipment. Furniture and fixtures, fixtures and fittings. Fittings mean door, windows. Motor vehicle mean cars, trucks, lorry, etc. And total non-current assets are 200,000. After non-current assets, we record current assets. What are the current assets? Inventory that we bought for resale purpose. As we need to resell it within a year, that's why it is a current asset. Account receivable mean the customer to whom we sold the goods on credit, we need to receive. That's why it is our asset on. Prepayments, what are these? Prepayments mean
or
expenses paid in advance. Expense paid in advance.
period.
If suppose next month or next year expense we have paid in advance, so we will record it prepayments because these are our ons. And cash in hand or cash at bank. This is the total for current assets, total for non-current assets. We will add both. We will record as total assets. This is what business on in the form of assets. It should be equal to offs. What are offs? Equity plus liabilities. So non-current assets, current assets, we calculate total assets. And then we move towards second part of balance sheet, where we record equity plus liabilities. And second part, we will start from capital. Capital mean equity. Capital and liabilities we are recording now. So first we record capital mean equity. The capital at start of the year mean that owner invested into the business was this. During the year, what profit company have made, we will add there. This profit is also called retained earning. This profit is also called retained earning. And from this capital, we will deduct withdrawals. Withdrawals mean drawings that owner withdraw from the business. So this is total equity. After total equity, we need to record liabilities, and liabilities are also of two types. Non-current liabilities that we need to pay in more than 1 year. But bank loan, suppose for 5-10 years. What's the amount of loan? 25,000. So total non-current liabilities 25,000. Then we need to record current liabilities. Current liabilities mean liabilities that we need to pay during the year within 12 months. So these liabilities are greater than 12 months. These liabilities are lesser than 12 months, mean we need to pay them within 12 months. Accruals. Accruals mean expenses we have enjoyed in current, but we need to pay in future. Like the electricity bill of this month, we will pay next month. We haven't paid. That is our liability. We will record it as accrued, or we record it as expense payable. That we need to pay in future, meaning the benefit of that expense we have enjoyed. The electricity we have enjoyed in this month. we have used in this month, but we need to pay next month. So we will record at the end of this month as payable mean accruals. Accounts payable mean payable supplier from whom we bought the goods on credit. And bank overdraft, what is that? Sometime our bank allow us, if suppose your bank balance is a zero and you need to pay any amount to any other party, you can still pay from your bank account. Mean your bank account will be negative. That negative account balance is called bank overdraft. Next, when we deposit the amount into the bank, first that negative balance will be net off, and then the remaining balance will be converted into our positive bank balance. And bank doesn't allow to all people this facility, they allow to some people or some companies. And bank charge on this overdraft interest as well. So what is this bank overdraft? Mean our negative balance at bank. So that will also be called a current liability. Mean we owe this amount to bank. We need to pay this to bank in future. And these are total current liabilities, and equity plus long-term plus current liabilities is what business of. And this of and on are equal. So this is the picture of a balance sheet. Mean how to prepare balance sheet means statement of financial position. First we record the assets, non-current assets, then current assets. We calculate total assets. And then we record capital and liabilities, mean equity and liabilities, and we calculate total of equity, mean capital and liabilities. Is that fine? Now we are moving towards how to prepare profit and loss account. We have learned how to prepare statement of financial position. Now we are moving towards how to prepare statement of profit and loss account. But before moving to that, there are some terminologies. Definition. What is asset? An economic resource controlled by the business. Mean what business own? Controlled by the business mean it is in the ownership of the business. Business has a control over it. But are non-current assets an asset the business intend to keep longer than 12 months? Mean business will use this asset for more than 12 months. Mean this asset will provide us benefit for more than 12 months. Non-current assets. Current assets, not a non-current assets, means that assets will provide us benefit within a year. Inventory, an asset bought by the business intended for sale. Means stock we bought for resale purpose will be called inventory. Also called stock. And we use the word purchases for this. When we sold the inventory, we use the word sales. Accounts receivable, amount owed to the business by a customer if we are making credit sale. Then the customer will be called receivable. Mean this is amount owed to the business by the customer. Mean this customer have to pay to the business. Asset. Prepayments, a payment made by business in advance. In the next month expenditure, we have paid in advance like insurance premium. Capital, the amount owing by the business to the proprietor mean owner. The amount invested by the owner that business need to pay to the owner, because business is a separate, owner is separate. Drawings are withdrawals, anything taken from the business by the owner. Whether he is taking goods, whether he is taking asset, whether he is taking cash, it will be called drawings. Liability, amount owing by the business mean what business of. Current liabilities are liability due within 12 months of statement of financial position date, mean we need to pay within 12 months from the year end date. Year end date mean date where company prepare financial statements. Non-current liabilities are liability due more than 12 months from the date of statement of financial position. Mean we need to pay not within 12 months, more than 12 months. Account payables, liability due to supplier that we need to pay, mean what business of to supplier from whom we bought goods on credit. And bank overdraft, liability due to bank, mean negative bank balance that we need to pay to the bank. So let's learn how to prepare statement of profit or loss account. How profit and loss account can be prepared. We will put the heading statement of profit or loss, and then we will mention the year end for the year ended 31st March 2009. Because on yearly basis we prepare financial statements. Profit and loss account will always be start with the figure sales revenue. What is this? Sales revenue. Total sale of the business for the year. This is not sale of asset. This is a sale of inventory, mean stock. Then we deduct cost of sale from this sale. What we are deducting? Cost of sale from this sale. How to calculate cost of sale? Opening inventory, mean inventory at start of the year, what was in the warehouse, plus purchases, mean how much inventory we purchased during the year. So 30,000 was from previous year, mean at start of the year. During the year we purchased 120, altogether how much? 150 minus what inventory left at the year end, mean closing inventory in your warehouse, that is of 40,000. So how much inventory we have sold? 110. Mean the cost of inventory sold is 110. Mean 30,000 we bought in previous year. 120 we bought in current year, mean purchases total 150. If out of this 150 we have remaining 40,000. So how much inventory we have sold? 110. At what amount? 180.
180, yeah.
So what's the difference? 70,000. That will be called our gross profit. Can you understand this? How to calculate gross profit? Sale minus cost of sale. So sale minus cost of sale is equal to gross profit. Gross profit can be abbreviated with the GP. How to calculate cost of sale? Opening inventory plus purchases minus closing inventory. Opening inventory means the inventory coming from previous year that we were having at the start of the year. Purchases mean purchase during the year. Closing, that is left at the year end. So the remaining we have sold. So we can calculate this cost using this formula. From gross profit, we need to deduct expenses and add other incomes. From gross profit, we deduct expenses and add other income, and then we will calculate the profit. What could be the expenses for the business? Rent expense, building rent, factory rent, shop rent, electricity bill, expense, telephone bill, mobile phone bill, expense, wages and salaries of the staff, expense, motor expenses. Motor vehicle is our asset. Motor expenses mean it's petrol, it's repair, maintenance expense, that will be called motor expenses. All these expenses will come together. How much? 31,000 we will deduct from the gross profit. to arrive at profit. What is this other income? Income from sale of goods will be recorded as sales revenue. These are income from any other source. Like we were having enough cash, we deposited into the saving account and we are receiving interest from the bank. So that will be called interest received income. If we are paying interest on the loan, that will be our expense will be recorded here, interest expense. But if we are receiving interest from any deposit saving account, that will be our income. This income is not generated by selling of inventory. That's why this will be recorded separate rather than as sales. Rent received. We were having a extra property that we rented out and we are receiving rent income from that property. That is income, but it's not coming from sale of goods. That's why it will be recorded separate rather than added to the sales revenue. So in GP gross profit, we add other income and we deduct all the expenses to arrive at the profit. So how gross profit can be calculated? Sales less cost of sale. How cost of sale can be calculated? Opening stock inventory plus purchases minus closing inventory. How profit can be calculated? Gross profit, add other income and deduct expenses. We will arrive at profit. This will be called net profit. Sale less cost of sale, we will calculate gross profit. And by deducting expenses and adding income to gross profit, we will calculate net profit. So there are some terminologies, revenue. This terminology is used for sale of goods. Either we can use word revenue, we can use word sales, we can use word sales revenue, or there is another terminology used for this that is called turnover. Sales turnover, sales revenue. All these terms meaning same means sale of goods. Purchases word will be used for purchase of goods, not for purchase of any asset. If we are purchasing car, we will not use purchase, we will use car debit, mean that asset name will be debit. If we are purchasing goods, we will not debit inventory, we will debit purchases. Goods mean inventory. Trading account, leave it, forget about it. Just one small topic more, and then we will go for break. There are two types of expenses. One is called revenue expenditure. Expenses mean expenditure. And other is called capital expenditure. The expenses, those are recorded in profit and loss account, will be called revenue expenditure. Revenue expenditure means expenses relating to profit and loss account. They must be recorded in profit and loss account. What are those? rent expense, electricity, telephone bill, wages and salaries, motor vehicle, interest expense, or you can also say purchases, purchase of inventory. The expenses relating to non-current assets will be called capital expenditure and they should be recorded in statement of financial position. So revenue expenditure we will record where? In a statement of profit and loss account. While capital expenditure is relating to purchase of assets, non-current assets we will record where? Statement of financial position, SOFP, SOP and SOFP. Can you understand this? If we are paying money to bought any non-current assets, that will be called capital expenditure. If we are paying money for routine expenses, that will be called revenue expenditure. Like rent, electricity, telephone, wages, salaries, insurance, interest, etc. So you should note that from the previous exercise that when we pay for anything, there are two possible reasons. Either we buy an asset, mean capital expenditure, which appears on the statement of financial position, mean balance sheet, or we pay an expense which appears on the profit and loss account. We call the purchase of asset for statement of financial position capital expenditure. Whereas the payment of expenses for profit and loss account will be called revenue expenditure. So we can differentiate between revenue and capital expenditure. So what we have covered so far? We have covered how to record accounting entry, how to make accounting entry for a transaction. Every accounting entry should have a debit as well as credit side. And this debit credit side should always be equal. If we are recording something as a debit, there should be something as a credit. Otherwise, this accounting entry is incomplete. It's not that either one thing on the debit and one thing on the credit. No, there could be more than one thing on the debit or credit side, but debit credit side could be equal. Should be equal. And while recording accounting entry, we need to keep in mind some rules. If cash coming in, we will debit it and the other account balance will be recorded as credit, like selling goods, cash coming in, cash debit. What could be the on credit side? Sales. If cash going out, we will record it as credit. Suppose we are buying goods, so cash going out credit. What could be on the debit side? The other account balance mean purchases. And assets and expenses is having a debit nature. And if they are increasing, they will be according to their nature mean debit. Asset and expenses are having debit nature. And if they are increasing, they will be debit. If they are decreasing, they will be credit. Cash is an asset, increasing debit, decreasing credit. Receivable is an asset, increasing debit, decreasing credit. Car shop, increasing debit. Liabilities, income and equities are having credit nature, and if they are increasing, we will credit them. Capital increasing, cash debit, capital credit. Payable increasing, we bought goods on credit. So purchases debit, payable credit. And when they are decreasing, we will debit them. We are paying to payable. So cash, credit, what is debit? Payable. because payable is decreasing. We are taking loan from the bank. Loan liability debit or credit? Liability increasing or decreasing? Increasing. We will credit loan. What we have taken cash, cash will be debit. If we are paying loan, so cash credit. And liability decreasing, we will debit loan. Can you understand this? And what we have covered, the ons and offs side should always be equal. Mean assets should always be equal to equity plus liabilities. How we have calculated some examples in how ons and offs the side will remain equal. We have covered a picture of statement of financial position, how it is prepared, a good picture of statement of financial position. And we have covered a good picture of a statement of profit or loss account, how it is prepared, how to calculate gross profit we have learned, how to calculate cost of sale we have learned, how to calculate net profit we have learned. And we have learned the difference between capital and revenue expenditure. Let's take a break for 20 minutes to refresh your mind. We'll see you back after 20 minutes. Financial accounting. So let's move towards chapter 3 of our book. Double entry and bookkeeping concept. Okay. Let's discuss a few things. We are going to discuss a sales system. In how company record the sales, what the documents company normally prepare during sale.
Sorry.
So when a company receive order from the customer, they prepare a document called sale order. When company receive order from the customer, company prepare a document called sale order, and company keep record of this document, because this document is having detail about the customer, about the number of units he has ordered, and the price you have agreed with the customer, and when you need to deliver the goods to the customer. Without this document, deliveries might be delayed. And if you are delaying delivery to the customer can charge you penalty because his requirement was not met. So while receiving order, company generate a document called sale order, and when companies send the goods to the customer, they prepare a document called dispatch note, also called goods dispatch note, means GDN. Along with delivery of goods, companies send a document about the detail of delivery that is called dispatch note. After dispatch note, companies send sale invoice to the customer, mean bill for the amount received. We are talking about credit sale. Against sale invoice, company record the accounting entry in a sale day book. Where company record the accounting entry in sale day book. And company update the ledger. Which ledger? Receivable. So while receiving accounting period documents called dispatch note, then company prepare a bill that will be called a sale invoice that is sent to the customer to request for payment. And against sale invoice, company record the accounting entry in sale day book and update the receivable ledger, mean customer ledger. When company receive money from the customer, receive what? Cash from the customer. Company update the cash book. Mean this much cash has been received from whom? From the receivable. So company update the receivable ledger as well. So this is the sales system, mean how company record the sales. Now let's discuss about purchase system. Mean what document company prepare in purchase system. If we are placing order to supplier for purchase, we will prepare a document called purchase order. And company keep this document in record. This is a proof that company have placed the order to the supplier. But before this purchase order, Before placing order, company obtain quotation from the supplier. And if company want to purchase anything, any asset, any inventory, they ask different suppliers to send their quotation. And they will sell this product at what amount. And by receiving different quotations from different suppliers, company can decide who is the supplier who providing the goods or the asset at lower amount at high quality. So company will place order to that supplier. And those quotations company keep in record so that anybody can check whether you have performed this process or not. If company is buying without quotation, there could be chances of fraud. Might be purchase department people are buying from any of their friends and asking them, please put the invoice of more money, like charge the asset at a high price, and the remaining amount we will distribute with each other. So that's why to avoid that kind of fraud, there is a policy. First, you need to take 4 or 5 quotations. And based on those quotations, you need to see who is providing high quality at low price, to whom you should place the order. And then while placing order, company prepare a document called purchase order. And when company receive the goods from the supplier, along with the goods, company will receive a document called delivery note. And this delivery note will be called GRN, good received note. In sale, there is a GDN, good dispatch note. In purchase, there is a good received note. And then company will receive invoice from the supplier. For the supplier, that invoice is sale invoice. And for us, that invoice will be called purchase invoice. And against purchase invoice, company record the purchases in purchase day book. And these purchases are credit purchases. So company update the ledger. Which ledger? Payable ledger. And when company pay to the supplier, meanwhile making payment to supplier, company update the cash book like this cash has been gone out, credit, as well as company update the payable ledger, mean reduce the payable liability. So these are the system called sales system and purchase system. Can you understand this? Let's discuss 2 more terms. Suppose we have sold some goods to the customer. After sale, customer might return some of the goods. And if customer is returning some of the goods, that will be called sale return. If customer selling goods back to us, that will be called sale return. If after purchasing, we are returning some goods to the supplier, that will be called purchase return. Against sale, company issue a document called dispatch note. Against purchase, company made a document called GRN, good received note. In the similar manner, against sale return, company issue a document called credit note. While against purchases, company issue a document called debit note. Now let's discuss these things. What are these? In a business company, Purchase system. This is purchase system. First, we receive quotation from the suppliers. Then we place order and make a document purchase order. In sale, we make a document sale order. In sale, we made a document good dispatch note, while in purchase, we make a document good received note. Invoice in sale, that will be called sale invoice. In purchase, that will be called purchase invoice. Credit note against return. Detail of supplier name and address contain detail of goods return quantity, mean everything relating to return is mentioned on it. What is this statement? We're gonna discuss after a bit. Debit note will be against purchase return. Remittance advice mean when we pay money to the supplier or receive money from the customer, that money detail is called remittance. Mean transfer of money from one party to another. The record of that transferring of money will be called remittance advice. And receipt, what is the receipt? Detail of payment received that we give to the customer and receive from the supplier. Yeah. Every month, our supplier send us his statement. Either he send the invoice, mean bill, or he statement, or he send what? Supplier statement. Supplier statement is a statement that is showing our balance of to the supplier. Mean every month, our supplier send us his statement. Like at the start of month, this was the balance due. During the month, you made these purchases, and during the month, you paid these amounts. So this is your closing balance of that you need to pay to me. So that will be called supplier statement, so that we can compare this statement with his ledger and see what the money he is asking, whether in our record the money is the same or not. The amounts are same or not. So we have learned what is the sales system, what documents has been generated in sales system, and what is purchase system, and what documents have been generated in purchase system. Now we are moving towards accounting records. Mean what are the accounting records where company need to record the transactions? Company need to record the transactions in books of prime entry. Mean first, the transaction will be recorded where? In books of prime entries. And there are 7 books of prime entries. What are 7 books of prime entries? Sale day book, sale return day book, purchase day book, purchase return day book, cash book, petty cash book, and the journal. What are the books of prime entries? Sale day book, sale return day book, purchase day book, purchase return day book, cash book, petty cash book, and the journal. Sale day book is used to record credit sales. Meaning sale day book will record what?
Right.
Credit sales. And credit sale return will be recorded in sale return day book. In purchase day book, we record credit purchases. And purchase return will be recorded in purchase return day book. In cash book, we record everything buying, selling of cash, mean cash items, where we are paying cash, not the credit. All other accounting entries will be recorded in journal. What is petty cash book? Petty cash book is a book where we record the routine day-to-day expenditure. There are some routine day-to-day expenditure of the business. What could be those? If any guest is coming into the business, you need to offer him coffee, cold drinks. The amount of that coffee, cold drinks expense will be recorded in petty cash. Business need to buy paper for printer, need to buy stapler pen, stationery. Those day-to-day routine expenditure will be recorded in petty cash book. Employee tea material like milk, tea, sugar, those expenditure will be recorded in petty cash. If you have sent any employee to deliver something to any other party and the fare used while delivering the goods will be recorded in petty cash. How this petty cash will be maintained? At the every start of month, suppose company have calculated like our normal petty cash expenditure is say $1,000 every month. So what the company do? They handed over $1,000 at the start of the month to the clerk. So that during the month, clerk can pay for small expenditure from this $1,000. Suppose the month expenditure is 750. How much amount clerk is having? 250. So the start of the next month, he will be given 750 so that 1,000 at the start of the month should be with his pocket so that he can pay small expenditure during the month from this amount. This 1,000 that we have stated as monthly expenditure and we are giving 1,000 or we are maintaining 1,000 with the clerk for monthly expenditure is called float. At the start of every month, a float is maintained for the clerk. Minimum account balance or amount is maintained at the clerk so that he can pay small expenditure, petty cash from this float. And at the start of month, you are checking how much amount he has left and the remaining you are giving him to maintain the float. This system will be called impressed system. Impressed system of maintaining petty cash. Maintaining float at the start of the month by giving amount spent in the previous year so that at the start of the month that float should be maintained with the clerk. So this system will be called impressed system. So petty cash book to record daily routine expenditure. So these are 7 books of prime entries. Meanwhile, performing transaction, the transaction recorded first where in books of prime entries. Credit sales will be recorded in sale day book. Credit sale return will be recorded in sale return day book. Credit purchases will be recorded in purchase day book, and return purchases will be recorded in purchase return day book. And cash transaction will be recorded in cash book. Petty cash expenditure will be recorded in petty cash book. All other entries will be recorded in journal, especially at the year end. Company made some year end entries, and that year end entries will be recorded in journal. From these books, accounting entries will be just from accounting trial balance finance of statement of cash flow, statement of changes in equity, and notes to the accounts. So the that they can show to the student. Okay. So first transactions are recorded in books of prime entry. From books of prime entry, ledgers are prepared. After ledger, trial balance is prepared, and after trial balance, company prepare financial statements. What are books of prime entry? We have discussed. So these are 7 books of prime entries. Sale day book for recording credit sale, purchase day book for recording credit purchases, sale return, return of goods sold on credit, purchase return, return of sale book would be like this. Sale day book. Is on 320 X Jack for the 145. Is for now. Okay. Farm is of 2700. From there is 155. From Hamai supplier this amount, Neville this amount, and Draco this amount. These are our supplier names. Like this. Your registration. What we need to do. Write up the following credit transaction arising in the first 2 weeks of August into the relevant day book. Mean we need to identify in which degree of purpose of these transactions. Mr. Baker, this business on means because this Victor is a customer who purchased goods from MK Link. So this will be recorded in sale day book. On 1st August, MK Link purchased equipment at a cost of 2000 from wholesaler Tin Pot Limited. There is no word of cash. If party name is there, this means this is credit purchases. So this will be recorded in where? Purchase date. MK Link returns goods costing 150 to another supplier iCook. If MK Link return, this means he has sold or he has purchased before. If we have should be So we sand buys our new oven for 4,000. Come on. Oh my God. Okay. I 4,000. Sale debut because our name is MK Link. MK Link purchase baking trays for 500 from regular supplier. Purchase debut. And MK Link purchase oven costing 10,000 from hot stuff. Purchase debut. MK Link returns equipment costing 300. Purchase return debut. Powell Ova purchase goods costing 2,200. Sale debut. And M Becker will buy some oven proof dishes costing 600. Mean if other parties buy, this means we sold. If we buy it, we purchased. Let's move forward. The cash book where we record cash receipt as well as cash payment. Cash book will look like this. This side will be called debit side and this side will be called credit side. Any cash received will be recorded here. Party's name will be recorded here. Here will be dates. Any cash payments will be recorded here. Party names will be here and here dates. The cash book is used to record cash receipts and cash payments. So we can say these are the receipts and these are the payments. We divide into two halves. Okay, see this, the cash payment book. On 18th of July, company paid cash, how much? 1,400 to a payable means supplier for 1,400. And company received the discount of 100 from this transaction. How this transaction can be recorded? What should be recorded on the debit and what should be recorded on the credit? If cash payment, this means cash will be recorded on the credit side of 1,400. And the payable, what's the name of the payable? MRA. Either you can use that name or you can record payable 1,400. On 18th of July, 3,000 payment for rent. So rent expense debit, cash credit. On 18th of July, 210 to a payable. So cash credit, payable debit. And on 18th of July, 1,600 to a payable. 1,600 payable debit, cash credit. And rent debit, cash credit. Altogether, how much they have paid? 6,610. Out of this 6,610, 3,210 have been paid to payables. And 3,400 has been paid to rent. So we can make a combined entry. What? Credit cash, how much? 6,610. Debit, what? Payables with the amount of 3,210. And debit, what? Rent expense with the amount 3,400. So we can make a combined entry like this. The debit side 6,610 is tallying to credit side 6,610. Petty cash. What is petty cash? The petty cash must be kept in petty cash books. Mean clerk have to put the cash in a box in a drawer, not in his pocket. If he is keeping the petty cash in his pocket, he will be paying his personal expenditure from that. So that's why the cash must be put in the petty cash box. And from that box, he will be paying the petty cash amount. The petty cash box must be secured in a safe. Mean that drawer must be locked so that the cash cannot be stolen easily. The person responsible for petty cash, mean that clerk, must be reliable and understand what they are required to do. Mean he should understand why this cash has been handed over to him. This is for routine expenditure, not for his personal expenditure. The cash should only be used for business routine expenditure. Petty cash voucher. All petty cash must be supported by invoices. If he is paying cash for any expenditure, he should keep the bill invoice with his record so that management can ask anytime how much cash you are having. He's saying 500. Where are the remaining 500? He can show the bill invoices. These are the 500 payers. So he should keep record of the invoices of payments. He should keep record of the bills against expenditure. Petty cash vouchers must be signed by the claimant and the person responsible for running the petty cash. If suppose sales department people have a order, we need a printing paper. And this clerk have bought the printing paper for sale department. The bill for the printing paper should be signed by the sale department, like we asked him to pay this amount. So that every expenditure should be properly authorized by the person who made the expenditure, who asked him to pay for this. Regular spot check must be carried out to ensure that the petty cash is accurate, and another person after a week, after 10 days must check how much cash he is having in petty cash box and how much are the expenditure, to see he is not using that money for his personal expenditure. Otherwise, there could be fraud. Petty cash book. In this book, the business will record small cash transactions. The cash receipt will be recorded together with the payment, which will be analyzed in the same way as cash book. An impressed system will be adopted for the petty cash book. Impressed system means at start of every month, you are putting the money into the box that have been spent in the previous month to maintain a float. Float means a minimum amount that you have set. Any amount is withdrawn from the bank account which is transferred to a petty cash float. This float will be used to pay for the various sundry expenses. The petty cash book cashier will record any payment. Any expenditure must be evidenced by expense receipt, mean bill, and petty cashier will attach a petty cash voucher to each expense. He should keep record of vouchers. Vouchers mean bills. At any point in the time, the cash together with the expense voucher should agree to the total float. Mean if he's having a 400 in the box, so he must have a voucher of 600 so that the float can be checked. At the end of the period, the petty cash float is topped up. Topped up means if suppose during the month there are expenditure of 800, so he's having remaining 200. So petty cash will be topped up with 800 to maintain the float at the start of the month. By the withdrawing an amount from the bank totaling the petty cash payment made during the period. So what is float? What is impressed system? What is topped up? We have none of. So now we are moving towards what kind of entries we record in the journal. In the journal, we normally record accounting entries relating to year-end adjustments. Mean at year-end, company need to record some entries that will be recorded in journals. What could be those entries? Those entries could be relating to depreciation for the year. What is depreciation? Suppose
So,
company have bought an asset for 100,000 and company management have estimated that this asset can be used for 10 years. All assets should be depreciated over its useful life. If the asset cost is 100,000, its life is 10 years. This means every year company need to charge depreciation as 10,000 in profit and loss account. Because company is using that asset to generate revenue. So we need to charge the cost of asset every year to the revenue. How we will record depreciation? We can calculate depreciation like this: cost divided by life. This is per year depreciation. In every year, company will charge this depreciation. Where? Profit and loss account. What is the accounting entry for depreciation? Debit depreciation expense. Credit accumulated depreciation. Accumulated depreciation. So this is the accounting entry for depreciation that company need to pass for every asset at the year end. For land and building, the depreciation will be separate, motor vehicle will be separate, furniture will be separate. For every non-current assets, company need to record depreciation at the year end. What is the accounting entry? Depreciation expense debit, accumulated depreciation credit. At year end, we need to record irrecoverable debt written off. What does that mean? Company made a sale on credit to the customers and they record a receivable in the financial statements as an asset. Mean this money we need to receive from the customer. If that customer from whom we need to receive money is become bankrupt or is we cannot find him where he is, he's gone somewhere. So can we receive that money? No. That will be called bad debts. That will be called bad debts. So for bad debts, we need to record accounting entry at the year end where in journal. And what is the accounting entry? Debit, irrecoverable debt, credit, account receivable. Debit, irrecoverable debt, and credit, receivable. Mean we need to reduce the receivable because this receivable will not be collected. So debit, irrecoverable debt, credit, receivable. Record the movement in allowance for receivable, leave it for now because we will study a complete chapter on the bad debts. So we will cover this over there. For accruals and prepayments, we need to record entries at the year end. What are the entries? We will learn a complete chapter on accrual and prepayments. Leave it now. For a closing inventory at the year end, we need to record the accounting entry. How? Debit inventory, credit inventory. Debit inventory for statement of financial position and credit inventory for statement of profit and loss account. Now just learn what is the accounting entry of closing inventory, debit inventory, credit inventory. We will learn in detail about it in future. So in general, what accounting entries are recorded? Year-end adjustments relating to depreciation. What is the accounting entry of depreciation? Depreciation expense debit, accumulated depreciation credit. Relating to bad debts, irrecoverable debt debit, receivable credit. And relating to closing inventory, inventory debit and inventory credit. Except this, what we record in journals, acquisition and disposal of non-current assets. If company buying any asset or selling any asset other than inventory. So we will record in where journal rather than sale or purchase day book, because in sale purchase day book, we record only purchase of goods, sale of goods credit. But if company buying any non-current assets, selling non-current assets, their accounting entry where company will need to record in journal. Opening balance of statement of financial position item, leave it for a now. And correction of error, also leave it for. So what we record in journal, the year-end adjustment of depreciation, of bad debts, of closing inventory, and acquisition mean buying and disposal means selling of non-current assets. And after that, we need to prepare ledger. From ledger, we need to prepare trial balance, and from trial balance, we prepare financial statements. That's your understanding too. What journal should eager post mean? We need to record the accounting entry for these transactions. Igor Romanov, the name of a person. He's a very good chef, but not quite so good at accounting. He doesn't know about accounting and needs help to record the following transactions. We have learned how to record the transactions, how to record double entry. So we need to record double entry for 1, 2, 3, 4. Number 1, closing inventory of 250 bottles of vodka at a cost of 2750 has not been recorded. So how to record the closing inventory? Debit inventory with how much? 2750, and credit inventory with how much? 2750. Easy. Inventory debit, inventory credit for closing inventory. We have just learned. The amount is given. Mean he is having inventory of 250 bottles. What is the amount of those 250 bottles? 2750. He's not saying 2750 each bottle. If 2750 each bottle, then we calculate the amount 2750 into 250. So 2750 is the amount of all 250 bottles. Number 2. So number 1 we have recorded. Number 2. Igor need to charge depreciation on his restaurant. He holds a 25-year lease which cost him 150,000 10 years ago. So what could be the depreciation? What is the cost of the asset? 150,000. How much is the life of the asset? He holds on 25-year lease, mean he will use this asset, mean this restaurant for 25 years. So how we can calculate depreciation? 150,000 cost divided by life of 25 years. So what is per year depreciation? It's 6,000. So what is the accounting entry for depreciation? Depreciation expense debit with 6,000 and accumulated depreciation credit with 6,000. Number 3. A regular customer V Shady maintains a tab behind the bar and he normally settle the amount outstanding periodically. He is having a customer V Shady who buys goods from him and he pay periodically after some days. For a week, during the week he is buying, at the end of the week he paid the full amount like that. Or for the full month he is buying, after the month he is paying. However, he currently owes 350. This means there is a receivable of 350. He owes to whom? To Igor. How much? 350. This means there is a receivable of 350 and has not been seen for some time. But he is not raised. Where he is, nobody knows. Igor has given up hope of payment and intends to write the debt off. This is bad debts. So how we will record? Debit, irrecoverable debt. How much? 350. And credit, we need to credit what? Receivable with how much amount? 350. Is that fine? Number 4. On the last day of the year, Igor bought 2 new sofas for cash. What he bought? Sofa. What is sofa? Current assets, inventory or non-current asset? Furniture. Non-current asset. The sofas cost 600 each. How many sofas he's bought? 2. So what is the amount of sofas? 1,200. But the purchase has not been reflected in the account. And he paid for cash. So what is the accounting entry? Debit what? Sofa or furniture. 600 each and he bought 2. How much? 1,200. What should be the credit? Cash 200. Is that fine? This is the purchase of non-current assets we will record in journal. Can you understand this? So there is one small topic left in this chapter that is called accounting equation. What is accounting equation? Ons and offs should always be equal. Ons and offs should always be equal. What your ons asset should be equal to equity plus liability. We have seen in the balance sheet. All asset balance must be equal to equity plus liabilities. Or we can say asset minus liability is equal to equity. Because if we transfer this liability to other side, it's adding on this side. So other side, it will be deducting. Asset is equal to equity plus liabilities, or we can say assets minus liabilities is equal to equity. So let's maintain accounting equation from this question. Assets is equal to equity plus liabilities. Number 1. Avon commenced business introducing 1,000 cash. So cash is coming, asset 1,000 coming. From where? From owner. So that will be called equity, capital plus 0. So 1,000 ons is equal to of 1,000. Number 2, bought a motor car for 400 cash. So number 2, bought a motor vehicle for cash, asset coming in, asset going out. So 1,000 plus 400 minus 400 cash is equal to equity 1,000 plus 0. So it will become 1,000 is equal to 1,000. This motor vehicle coming in, cash going. Number 3. So loan, what is loan? Cash. So 1,000 was there. First 1,000 more coming. 1,000 was capital and 1,000 liability will increase. So it will become 2,000 is equal to
2000.
2,000, but not like that. It will be like 1,000 capital plus 1,000. Number 4, purchase goods for 300 cash. So 2,000 goods are coming. How much? 300. Cash is going. How much? 300. So this will be 2,000 is equal to what? 1,000 plus 1,000 mean 2,000. So here he's having 2,000. Other side he's having 1,000 plus 1,000. Ending balance. And number 5, sold all of goods purchased on day 4 for 400 on credit. Where he purchased the goods? Here on number 2. He sold all the goods for 400. He bought in 400. He sold selling in 400. There is no profit. But he sold on credit. This means from this 2,400 goods are going. And if he's selling on credit, there will be receivable of 400. The other side will remain same. So balance will be 2,000 is equal to 1,000 plus 1,000. So we have solved this question, prepare accounting equation. This is called accounting equation. Mean assets is equal to equity plus liability. Easy? He has solved like this. This ledger we will learn in future, not now. How to prepare ledger we will learn in future. And this chapter is completed now. Shall we move towards next chapter? Chapter 4 is about accounting entries. We need to record accounting entries. Illustration 1C. Kamran pays 80 for rent by check. If he is paying by check, we will credit bank. What is bank? Is our asset. So credit will be bank for against what? Rent expense. So debit rent expense. Kamran sells goods for 230 cash, which is then banked. Mean he sold goods for 230, but what he received? Cash. So cash debit, sales credit. After that, he deposited the cash into the bank. So what could be the other entry? debit bank 230 and credit cash because cash gone and bank asset up. Kamran then purchased 70 of goods for resale using cash. So cash going credit. What could be the debit? If he is purchasing goods, purchases. So purchases debit, cash, credit. Kamran sell more goods for cash, receiving 3,400. Cash coming in, going out. Cash debit. What could be the credit?
Um,
Sales, sales, sales. If goods going out, we will record sale. If goods coming in, we will record purchase. Not goods. Is that fine? Accounting entries for this. Okay, now this is a MCQ. Afsar enters in the following transaction in his first month of trading. Buying goods for cash 380. Mean he paid 380. Mean 380 negative balance. Pay 20 in sundry expense. 20 negative balance. Make 1,000 in sale. 1,000 positive balance. Receive a bank loan of 5,000. 5,000 positive balance. Pay 2,600 for fixture. 2,600 negative balance. What is the total entry of the credit side of the T account? In cash book. Here we record receipt mean debit. Here we record payment mean credit. So these 380 will be there, 20 will be there, 26 will be there, 1,000 will be here, and 5,000 will be here. So what is the credit entry on the credit side? How much is the total? 3,000. Which option? This is credit side, isn't it? This is debit side. If he asks about debit side, 6,000. Okay, we need to record accounting entries for these sold goods for cash, cash, debit, sales, credit. Cash, debit, sales, credit. Paid insurance premium by check. Insurance premium, expense, debit, bank credit. Sold goods for 250, the customer will pay in a month, credit sale. Receivable debit, sales credit. Paid 50 petrol for the delivery van. Petrol expense debit or motor expense debit, cash credit. Petrol expense to cash, how much? 50. This is debit and this is credit because cash is going out. Bought 170 goods for resale on credit. Purchases debit, payable credit. Bought 57 of goods for resale paying by check. Purchases debit, bank credit. Bought a further 40 goods for resale paying check cash. Purchases debit, cash credit. Bought a new computer for the business for 800 paying cash. Computer asset debit, non-current assets is not goods. Computer debit and cash credit. Only purchase goods for 5,000 and pays by check, purchases debit, bank credit. Only make a sale to a customer 500, the customer pay in 30 days, receivable debit, sales credit. Only pays a telephone bill amounting 40 and pay by check, telephone expense debit, bank credit. Receive bank interest income. What you receive? Cash, cash debit, interest income, credit. Because income increasing. Purchase a stationery for 12 and pay cash, stationery expense debit, cash credit. Against this, what could be the debit? Stationery expense. What could be the credit? Cash. Sale to a customer 400, the customer pay cash, cash debit, sale credit. It's not credit sale. Noor had receivable of 4,500 at the start of 20x5. During the year to 31st December, credit sale of 45,000 were made and cash received of 46,500 from credit customer. Mean receivable balance was 4,500 at the start. He made a sale 45,000. Receivable up how much? 4,500. He received cash 46,500. How much left? 3,000. Debit balance or credit balance? Whether it is asset or liability. Receivable asset or liability. Receivable mean customer. Payable liability. Receivable asset, current assets. So it will be debit balance because this is asset, not liability. It's receivable. We need to pass accounting entries. Mate subscribed for 10,000 of share capital in the newly formed company, paying by check. Bank debit, capital credit. Purchase supplies costing 4,000 and paid by check. Supplies also called goods. Purchases debit, bank credit. Purchase a delivery van for 2,000 paid by check. Van debit, bank credit. Purchase 1,000 of purchases on credit. Purchases debit, payable credit. Sold goods 1,500 and received a check for that amount. Bank debit, sales credit. Sold all remaining goods for 5,000 on credit. Receivable debit, sales credit. Paid 800 to the supplier by check. Bank credit, supplier debit, payable debit. Paid rent 200 by check. Rent expense debit. What credit? Bank credit. This chapter is also finished. We'll see you in next class with chapter 5. Chapter 1, 2, 3, 4. We have covered so far. In this chapter 4 was all entries.